A few minutes after the closing bell this week, Google announced the most profitable quarter any company has ever reported. $112 billion in 90 days. That's nearly 4 times what it made a year ago. Here's the strange part. The money Google made on paper this quarter was more than double what it made from actually running Google. Search, YouTube, cloud, the ads, all of it, combined. And if you own an index fund, that paper profit is sitting in your retirement account right now. It can evaporate as quietly as it appeared. Once you see how this number was made, you won't read a profit headline the same way again. There is a difference between a company making money and a company marking money, and this quarter is the cleanest lesson in it you will ever get. So where did $112 billion come from? Start with the obvious suspect, the business itself. Google's actual businesses did grow. Revenue was up about a quarter from a year ago. For a company this size, that's a strong result. But a quarter more revenue does not turn into 4 times the profit. Something else did most of the lifting. The easy answer, the one most of the headlines reached for, is that the AI bets are finally paying off. Google has poured tens of billions into artificial intelligence. Maybe this was the payoff quarter. That answer turns out to be half right. And the wrong half is where this story lives. Because something about that night didn't add up. The biggest profit any company has ever printed dropped after the bell, and the stock barely moved. A record like that, and the market shrugged. The people who moved serious money were reading a number the headlines weren't. Remember that shrug. Once you can explain it, you can read any earnings report on the planet. First, let's be fair to Google, because the business under the headline is genuinely good. Cloud revenue grew 82%. That is not a typo. The cloud division nearly doubled in a single year. The orders they've signed but haven't delivered yet crossed $500 billion. And the profit from simply operating the business before any accounting effects climbed about 30%. The margins got fatter, not thinner. By any normal reading, this was a great quarter. But look at the gap. A great quarter for Google looks like $40 or $50 billion in profit. Not 112. Every real, impressive thing I just listed still leaves you tens of billions short of the record. So the record was not built out of ads or cloud or search. It was built somewhere else. It was built on a single line near the bottom of the report that almost nobody reads. The line is called Gain on Equity Securities. Last year, on that same line, Google reported a little over $1 billion. This year, $99 billion. That one line is bigger than the entire rest of the company's profit. So what is it? Google owns pieces of other companies, not whole companies, just stakes. It owns a slice of Anthropic, the AI lab. It owns a slice of SpaceX, the rocket company. And since a rule change back in 2018, Google has to do one specific thing with those stakes every 3 months. It has to look up what they're worth now and report the change as profit or as loss. Even if it never sells a thing. Accountants have a name for that. They're marking the asset to the market, mark to market. On this channel, let's just call it the mark. A number that lives on the books and moves on its own, without anyone selling, shipping, or shaking hands on anything. This quarter, private investors decided Anthropic and SpaceX were worth far more than before. Google didn't sell, Google just wrote the new number down. And the rule turned that markup into $99 billion of reported profit. Think about your own home for a second. Say a housing app tells you it's worth $50,000 more than last year. Did you earn $50,000? You can't spend it, it could vanish next month. Nothing in your life actually changed. Now picture a rule that forces you to write that $50,000 down as income, as if it were salary. That is Google's quarter, times 2 million. And then the capper. The taxman saw the $99 billion and sent a bill. Google booked a $22 billion tax charge against the gain. But even most of that tax hasn't been paid in cash. It's a charge on paper against a profit on paper. Even the tax on money nobody spent is money nobody spent. Now, if one line of accounting can turn a price lookup into $99 billion of profit, you'd expect somebody to have seen the trouble coming. Somebody did. Years early and louder than anyone. His story starts where the rule starts, back in 2018. And the rule was not built to trick anyone, just the opposite. It was built to make company profits more honest. For years, firms could sit on the gains and losses in their investments and reveal them only at a convenient moment. The new rule said no more hiding. Report what your stakes are worth every single quarter. A cleaner rule with one strange side effect. Warren Buffett spotted it the instant it landed. Buffett runs Berkshire Hathaway, which holds enormous piles of other companies' stock. So he wrote to his shareholders and he warned them. This new accounting, he said, and I'm quoting him, would produce truly wild and capricious swings in our bottom line. Ignore them, he told his investors. Watch the operating business instead. Then he proved his own point. In 2018, a bad year for stocks, Berkshire reported $4 billion in profit. The very next year, the market rose and the same company reported $81 billion, 20 times more. Nothing about the businesses Berkshire owned had changed 20-fold in 12 months. The mark did all of it. Buffett stood there telling everyone the number was noise, on purpose. Buffett treated the mark as noise to be ignored. Our next character did the opposite. For him, the mark became the whole show. Meet Masayoshi Son, the founder of SoftBank. Son runs one of the largest investment funds on Earth, a fund that mostly just holds stakes in other technology companies. Which means his reported results live and die on the mark. Watch it swing. One year, the companies his fund held got repriced downward, and it reported a loss of nearly $18 billion. A few years later, the same kind of stakes got repriced upward, driven largely by a markup on its bet in OpenAI, and the fund flipped to a $46 billion gain. Same fund, same rule, opposite sign. Sun didn't run a different business between those two reports. The market simply changed its mind about what he was holding. His fortune doesn't sit still on the page, it breathes in and out with the mark. And Sun's swings leave one question hanging over Google's record. A mark is only ever as fresh as the day it was taken. By the time Google read its record out loud, something had already happened to it. That twist is coming, right after the strangest case of all. Because the strangest case is also the mirror image of Google's. Rewind to 2015. Yahoo, the fading web giant, owned a large stake in a Chinese company called Alibaba. And that stake had grown into something gigantic. So gigantic that Wall Street started doing the math backwards. Analysts took everything the market said Yahoo was worth, then subtracted the value of the Alibaba stake alone. And the answer came out negative. The market was quietly saying Yahoo's own core business, its search, its email, its ads, was worth less than zero. A stake Yahoo had never sold was worth more than the whole company holding it. With Google today, the mark blows the picture up. With Yahoo, the mark ate the company alive. Same force, opposite direction. Which brings us back to that shrug. The biggest profit in history and a stock that barely twitched. Now you can read it. The professionals who move serious money don't read the headline. They read the operating line, the profit from actually running the business. And they saw a good quarter wearing a historic costume, so they priced the good quarter and shrugged at the costume. One well-known analyst even argued the stock should have risen that day on the strength of the cloud growth, not the record. The loud headline said most profitable quarter ever. The people reading closely just nodded at the cloud numbers. That gap between the headline and the professionals is the mark sitting in plain sight. Which leaves the twist that's been hanging over this whole story. Something had already happened to Google's record before anyone heard it. Here's how. The mark is a photograph. It captures what those stakes were worth on one single day, the last day of the quarter, the 30th of June. But Google didn't read the number out until 3 weeks later, and in those 3 weeks, one of those stakes moved. SpaceX, freshly public, had already fallen by roughly a third from where it stood when the quarter closed. So a chunk of the record profit had quietly evaporated before Google ever announced it. The photograph was out of date the moment it was framed. Now widen the lens all the way out, because this is where it gets genuinely odd. Part of Google's paper profit comes from its stake in Anthropic, and Anthropic is contracted to spend heavily on Google's own cloud, buying its computing power back from Google. So Google puts money into Anthropic. Anthropic's value goes up, Google marks that gain as profit, and Anthropic spends a slice of Google's own money right back on Google. The money runs in a loop. Some short sellers have started pointing at exactly this shape across the whole AI industry and asking one simple question. If the biggest profits of the boom come from companies marking up their bets on each other, how much of the boom is real and how much of it is the mark? You don't need an accounting degree to carry this. You need one question. Did anybody actually sell anything? If Google had sold its Anthropic stake and banked the cash, that would be money. It didn't. It looked up a price and wrote it down. So here's the whole video in one line. If nothing was sold, it's a mark, not money. That is the difference between making money and marking money. And it's a lens you can use this week. Because the rest of earnings season is coming, Microsoft reports in a matter of days and the headlines will tie its profit to its stake in OpenAI. When they do, ask the question. Microsoft's stake works a little differently. Its number tracks OpenAI's actual results, not just a market price. But the same question still sorts it. Did anyone sell anything, or did somebody just mark it? Either way, you'll be reading the report the way the professionals read it, one line ahead of the headline. If you want the next shift in the business of AI decoded before it's obvious in hindsight, subscribe. That's the whole reason this channel is here.